Today we're diving deep into a dividend powerhouse, the DVY ETF, also known as the iShares Select Dividend ETF. Income investors, this one's for you. DVY is all about delivering those sweet dividend payouts, but is it too good to be true? We'll crack open the DVY box and see what lies inside. We'll explore how DVY stacks up against the market, how it manages risk, and whether there might be even better dividend options out there. So buckle up, grab your notepads, and get ready to learn everything you need to know about DVY. What is DVY ETF? DVY, ticker symbol for the iShares Select Dividend ETF, is an exchange-traded fund, ETF, designed to track the investment results of an index composed of U.S. equities with a history of paying relatively high dividends. Here's a breakdown of what that means. Exchange-traded fund, ETF. Imagine a basket containing various individual stocks. An ETF operates similarly, but instead of a single company's stock, it holds shares of multiple companies within a single tradable unit. You can buy and sell DVY shares on a stock exchange, just like any individual stock. Tracks an index. DVY doesn't pick and choose specific companies. Instead, it follows an index, in this case, the Dow Jones U.S. Select Dividend Index. This index identifies U.S. companies with a history of paying high dividends and applies specific criteria to select the final holdings. Focuses on high dividend-paying U.S. equities. The core objective of DVY is to provide exposure to companies with a strong track record of distributing dividends to shareholders. Dividends are a portion of a company's profit that it pays out to its stockholders. Investors seeking regular income often favor dividend-paying stocks or ETFs like DVY. Here are some additional details to consider. Physical replication. DVY utilizes a physical replication strategy. This means the ETF actually owns shares of all the companies included in the underlying index. When you buy DVY, you indirectly own a piece of each company within the ETF. Dividend distribution. Since DVY holds dividend-paying companies, it itself distributes dividends to its shareholders. The frequency and amount of these distributions depend on the dividends received from the underlying holdings. Benefits of DVY ETF. Diversification. DVY offers instant diversification across multiple dividend-paying companies, reducing risk compared to holding a single stock. Income generation. Regular dividend distributions can provide a steady stream of income for investors. Lower cost. Compared to actively managed dividend funds, ETFs, like DVY, typically come with lower expense ratios. What is the investment objective of the DVY ETF? The investment objective of the DVY ETF, or the iShares Select Dividend ETF, is to track the investment results of an index composed of relatively high dividend-paying U.S. equities. Here's a deeper look at what that entails. Focus on dividend yield. DVY prioritizes companies with a history of paying out a significant portion of their profits as dividends to shareholders. This focus on dividend yield caters to investors seeking regular income. Dividend payments provide a steady stream of cash flow, which can be particularly attractive for retirees or those depending on investment income. Value investing. Some investors believe companies with a strong track record of dividend payouts tend to be financially stable and well managed. Index tracking. DVY doesn't actively select individual stocks. Instead, it aims to mirror the performance of a specific index, typically the Dow Jones U.S. Select Dividend Index. This index uses specific criteria to choose U.S. companies with a history of high and sustainable dividend payouts. Key considerations. Passive management. Since DVY tracks an index, it's considered a passively managed ETF. The fund managers don't actively research and pick individual stocks, they simply ensure the holdings align with the underlying index. This approach generally leads to lower expense ratios compared to actively managed dividend funds. Performance benchmark. By tracking an index, DVY's performance is directly tied to the performance of the companies within that index. If the underlying companies experience strong growth and maintain high dividend payouts, the value of DVY is likely to increase. Conversely, if the holdings underperform, the value of DVY will decline. Diversification. DVY typically holds shares of dozens or even hundreds of companies. This diversification helps mitigate risk compared to investing in individual stocks. Even if a few companies within the index perform poorly, the overall impact on DVY's value is lessened. What is the expense ratio of the DVY ETF? The expense ratio of the DVY ETF, or the iShares Select Dividend ETF, is currently 0.38%. This expense ratio represents the annual fee that the fund charges investors to cover its operating expenses. Here's a breakdown of what that means for you as an investor. Understanding expense ratios. Think of the expense ratio as a percentage of your total investment in DVY that goes towards the fund's operational costs each year. For example, if you invest $10,000 in DVY, the expense ratio of 0.38% translates to annual fees of $38, 0.38% x $10,000. Impact on returns. The expense ratio directly eats into your investment returns. A lower expense ratio means a higher portion of your investment return stays with you. While 0.38% might seem like a small percentage, it can compound over time and significantly impact your long-term returns. Comparison to alternatives. It's important to compare the expense ratio of DVY to other similar ETFs or actively managed dividend funds. Generally, passively managed ETFs like DVY tend to have lower expense ratios compared to actively managed funds, which require more research and management resources. Additional considerations. Underlying holdings impact. While the expense ratio of DVY itself is 0.38%, there might be additional hidden costs associated with the underlying holdings. Some companies within the ETF might have their own fees associated with reinvested dividends or other custodial expenses. However, these are typically minimal compared to the overall expense ratio. Trading costs. The expense ratio is separate from any trading commissions you might incur when buying or selling shares of DVY through a brokerage. Be sure to factor in these trading costs when evaluating the overall investment expense. How actively is the DVY ETF managed? The DVY ETF, or the iShares Select Dividend ETF, is considered passively managed. Here's a deeper look at what this means and how it impacts your investment. Passive versus active management. Passive management, DVY, follows a predetermined strategy by tracking a specific index, typically the Dow Jones U.S. Select Dividend Index. The fund manager doesn't actively research and select individual stocks. Instead, they ensure the holdings of the ETF mirror the composition of the underlying index. Active management. Actively managed funds employ fund managers who research individual companies and make investment decisions based on their analysis. The goal is to outperform the market by selecting companies with higher growth potential. Benefits of passive management in DVY. Lower expense ratio. Passively managed ETFs like DVY typically come with lower expense ratios compared to actively managed dividend funds. Since there's less research and management involved, the fees associated with running the ETF are lower. This translates to potentially higher returns for investors. Transparency. The holdings of DVY are readily available and transparent. Investors can easily see which companies they are indirectly invested in through the ETF. Tax efficiency. Passively managed ETFs like DVY tend to have lower portfolio turnover compared to actively managed funds. This means the ETF buys and sells holdings less frequently, potentially leading to lower capital gains distributions, which can be taxable events for investors. Limitations of passive management. Tracks the index. DVY's performance is directly tied to the performance of the underlying index it tracks. If the index experiences strong growth, DVY will likely benefit. However, it also means DVY cannot outperform the market if the index underperforms. Limited flexibility. The fund manager has limited discretion in selecting holdings. They can only adjust the portfolio to align with changes in the underlying index. This might not be ideal if there are opportunities to capitalize on specific market inefficiencies. What is the turnover rate of the DVY ETF? The turnover rate of the DVY ETF, or the iShares Select Dividend ETF, is a crucial metric to understand its trading activity and potential tax implications. Here's a breakdown of what turnover rate signifies and how it applies to DVY. Turnover rate explained. The turnover rate represents the percentage of a fund's holdings that are bought and sold within a year. A higher turnover rate indicates more frequent trading activity within the fund. DVY's passive management and turnover. Since DVY is passively managed, it aims to track a specific index, usually the Dow Jones U.S. Select Dividend Index. The fund holdings are adjusted periodically to mirror the composition of the underlying index. This means the turnover rate of DVY is typically lower compared to actively managed funds. Impact of turnover rate. Tax implications. When DVY sells holdings at a gain, it might trigger capital gains distributions for investors. These distributions can be taxable events, depending on how you hold the ETF, e.g., within a taxable account versus a tax-advantaged retirement account. A lower turnover rate in DVY generally translates to less frequent capital gains distributions and potentially lower tax liabilities for investors. Investment performance. While a very high turnover rate can erode returns due to trading costs, a moderately low turnover rate like DVY's can help minimize these expenses. It also allows the fund to capture the dividend income from the holdings for a longer period, potentially benefiting investors seeking regular income. Does the DVY ETF distribute dividends frequently? Yes, the DVY ETF, or the iShares Select Dividend ETF, is designed to distribute dividends frequently, typically on a quarterly basis. Here's a breakdown of how DVY distributes dividends and what it means for investors. Focus on dividend-paying companies. DVY invests in U.S. equities with a history of paying out dividends. As these companies distribute their profits to shareholders, DVY receives those dividends. Distribution to shareholders. DVY doesn't necessarily retain the dividends it receives from the underlying holdings. Instead, it aims to distribute a significant portion of these dividends to its own shareholders, following a predetermined schedule. Targeting quarterly distributions. DVY typically distributes dividends on a quarterly basis. This means investors can expect to receive dividend payouts 4 times a year, subject to any changes in the underlying holdings or the ETF's distribution policy. Benefits of frequent distributions. Regular income. For investors seeking a steady stream of income, DVY's frequent dividend distributions can be a significant benefit. This can be particularly attractive for retirees or those depending on investment income to supplement their lifestyle. Potential for reinvestment. Dividends received from DVY can be reinvested to purchase additional shares of the ETF. This allows investors to benefit from the power of compounding over time, potentially growing their investment returns. Important considerations. Not guaranteed. While DVY targets quarterly distributions, it's important to remember that dividends are not guaranteed. The companies within the ETF can decide to reduce or even eliminate their dividend payouts altogether. Tax implications. Dividend distributions from DVY are generally considered taxable income for investors, depending on how you hold the ETF, e.g., taxable account versus tax-advantaged retirement account. Be sure to factor in the potential tax implications of these distributions when evaluating your overall investment strategy. What are the primary risks associated with investing in the DVY ETF? While DVY offers potential benefits like income generation and diversification, there are inherent risks associated with any investment. Here's a breakdown of some of the primary risks to consider before investing in the DVY ETF. Market risk. Overall market fluctuations. The price of DVY, like any security, can fluctuate based on overall market conditions. Even though DVY focuses on dividend-paying companies, which tend to be more established, it's not immune to broad market downturns. A significant market decline could lead to a decrease in the value of your DVY shares. Industry concentration risk. Sector weighting. DVY tracks a specific index, and the holdings within that index might be concentrated in certain sectors. For example, the index might have a higher weighting towards financials or utilities, which are typically known for their dividend payouts. If a particular sector experiences a downturn, the overall performance of DVY could be negatively impacted. Credit risk. Underlying company issuers. DVY invests in individual companies. If a significant portion of the companies within the ETF experience financial difficulties or default on their debt, it could lead to a decline in the value of their stocks and ultimately impact the value of DVY. Dividend risk. Sustainability of dividends. Dividends are not guaranteed. Companies within the DVY holdings might decide to reduce or even eliminate their dividend payouts altogether. This could significantly impact the income generation potential of DVY. Liquidity risk. Trading activity. While DVY is a large and actively traded ETF, there's always a possibility of encountering lower liquidity, especially for smaller investors. This could make it slightly more difficult to buy or sell shares at your desired price, particularly during periods of market volatility,